I'm Drianne. I'm working with High Water Women for the Symposium, and I want to just make a quick introduction to this panel and to Laurie Spengler, who will be facilitating the discussion with Liesel Prtizker and Matthew Weatherly-White. This discussion is a framework for structuring a sustainable impact investing strategy. Laurie is going to be leading this discussion. Laurie is a serial entrepreneur herself and started many companies that are focused on sustainability. She is a leader and a manager. She is currently the president and CEO of Include, which is 100% focused on impact investing. So I turn it over to you, Laurie. Thank you very much, Liesel and Matthew.
Great, thanks, Drianne. It's exciting to be here and in this room this morning, and the energy following Clara's remarks and the clarity and conviction that she shared of Heron's journey in aligning 100% of their capital with the values and the vision that underpin the foundation. And we hope to build on that example in the conversation we're about to have this morning. As Drianne said, personally, I'm very excited to be here as a professional who's been challenging myself to use finance and business to build more inclusive and sustainable local economies. So this morning, as Sandra said in her opening remarks, we're going to spotlight a woman who gets things done in making capital deployment decisions, and her trusted advisor, Matthew from Caprock. And this really should demonstrate a partnership in action. That's what we're trying to showcase here this morning between the Blue Haven Initiative and Caprock. And we're going to have a conversation facilitated with a few questions that I'll put forward for about 20 minutes, 25 minutes. There are a couple of slides that Liesel and Matthew will reference, and then we'll open it up to the audience for another, I think, 20, 25 minutes, about 45 minutes altogether. And what we want to do in this conversation is move a little bit from the why. It still is about the action underpinning the capital allocation decisions, but a little bit of the story of the why, and then move into the how and some of the more nuts and bolts aspects of building the portfolio and looking at the results. So Liesel, if I might, I begin with you and just ask you to share with the audience kind of the philosophical framework that underpins and underpinned your decision. And I think it's very interesting to get a sense from you of how you came to that decision. I mean, it's not a light switch, it's not an overnight. There's kind of, I would imagine, a bit of an evolution, but how you really thought about using capital deployment opportunities and how to align those in initiatives that would have a positive and demonstrable environmental, social, and developmental outcomes. If you could share a little bit about your journey.
Sure. So I inherited my wealth and gained control of it when I was pretty young, when I was about 20. And I was in college at the time. I was studying African history. I was really interested in international development, and sort of then had this large pool of assets that I needed to make decisions about. And that was kind of terrifying. And there was a lot of responsibility associated with it, and I didn't really kind of understand what that meant. And so also kind of when you're in college and it's super awkward and you don't, it's kind of not like, it's quite a first world problem to have, and you can't really like turn to your roommates and sort of be like, I don't know what to do. Like, how do I set my asset allocation? And like, it's just super awkward. And so one thing that I did, which is also something that I love about High Water Women, is I traveled and actually volunteered, got into direct service. And I ended up volunteering at a microfinance organization in Tanzania. And that was I also volunteered and worked at a daycare center in India, which is going to serve me well. But both of those experiences were really kind of formative, and I started thinking about, you know, okay, why did I get born where I got born, and you know, why do I have access to all these resources and other people don't, and all these kinds of, you know, huge big questions that you ask yourself when you're having a life-changing experience. And I came back, and decided, well, obviously I have to become very philanthropic because that's what you do when you have lots of money and you care about the world. And so decided to start a foundation, but then increasingly became frustrated by the constraints that, aid, particularly, I was really interested in the international space. And you start looking at, legacies of aid and whether or not they've been effective and very good intentions, but sort of poor outcomes. And then you start looking at how capital markets play into all of this. And I was thinking, well, wait a minute. There's this whole other group of assets that I have quarterly meetings about. And, what are they doing in the world? And how can I be as thoughtful and strategic about those assets as I'm being over here on the grant-making side? And that's when I started, reading more, going to conferences, making friends, joining organizations, a lot of whom are in this room, and really started to think, well, I'm a whole person. There's a whole, I've got two sides of my brain, and also resources that aren't just philanthropic and aren't just there to make lots of money. And so what are all of the tools that I can use, and how does one sort of construct a portfolio around that? And so one of the things that, and also I'm a single, I'm married now, so it's me and my husband and our, growing family, but I don't have inherently a massive board of directors that I have to convince to do this. I'm actually able to be very flexible, which is a real gift and a real blessing. And so how can I move quickly and do those things and take advantage of the lack of frustration that I hear from other organizations that have quite a bureaucratic structure that they really have to shift. And so kind of that was, that process sort of took about, 4 or 5 years. And also was kind of a bit scary because, I didn't go to business school. I'm not a CFA. I didn't do my 2 years of iBanking training. And so, how do I enter this conversation, and particularly with financial advisors, and saying, and very much, I totally couldn't agree more with what Clara was saying around, I think everywhere you put your dollar has an impact. It just does. And it's not a neutral decision. And so I would like to think about what that impact is. And I would like to know what it is, first of all, and then make thoughtful decisions around what that impact is and take responsibility for what the impact is and see. And I think if you take that approach, you naturally will want it to do good things as opposed to doing bad things. And so how do you have that kind of conversation and then actually structure a portfolio that is, tax efficient and has liquidity and all of these things that you also need. And so that's kind of how I moved into that.
And let's pick up, before we turn to Matthew for a second, how you also then tapped financial advisory support. You gave an interview to Forbes a while ago that said, be careful when you share this decision, this intentional pursuit and alignment of capital with your value, to share it with financial advisors. They'll typically dissuade you. They'll say that you're going to lose a lot of money, this is a dangerous strategy, maybe dabble, maybe explore a little bit. But you obviously, you were not dissuaded. So tell us a little bit how you had the conversation, how you identified the right advisory support to accompany you on your journey.
I think though that there's a lot of, there's a perception bias and a sort of a hideous double standard against investing also with a social lens. So apparently it's perfectly fine to just straight up lose money, but if you lose money, because there's some kind of social overlay, well then that's really bad investing. And I don't know, like it's not, so yeah, well, obviously, clearly you all know what I'm talking about. So I think that that bias, though, is starting to be overcome. I mean, there's a lot of large institutions represented in this room. There's, social finance departments popping up with a lot of sort of traditional financial advisors, and I think that the tide is shifting in that direction. So I think it's probably conversations with financial advisors are probably easier now than they were when I had them, several years ago. But I think also it's about the process. So one of the things that I've learned is when you're asking for something that someone isn't necessarily, when you're asking something of a service provider that they don't know how to do, you can set yourself up for really misaligned expectations. And so when you're saying, I want this, but I haven't clearly defined what impact is yet, and I don't know what success looks like, it's really hard. What are you supposed to do if you're the financial advisor? You kind of, you want to direct your client to the status quo, because otherwise it's the blind leading the blind. And I think I didn't entirely understand that. And I think that one of the things that I've really learned is that you're sort of on this journey together, and you have to learn together, and how do you build a portfolio and try things out and test things out. And as a client, don't just sit there and fold your arms and say, parade for me all of these fantastic products, and they all need to be perfect and everything has to be thought through, otherwise I'm going to get very upset and take my business elsewhere. That's not realistic, and that's not actually how you build a field and how you build an industry. You have to solve problems together. And so that's one thing I've really learned on the client side, is that, you can't just kind of rattle this saber all the time. You have to work together and build something.
Right. Terrific. Thank you. It's a good segue, Matthew, to you. So tell us a little bit when you received the call from Liesel and how Caprock thought about this journey, and when you received the inquiry from Liesel, whether you felt Caprock was at that stage in a position to parade products, or whether this was in fact a journey that you were building some of the skills as well as identification possibilities to figure out the approach to the portfolio, let alone the development and execution of the portfolio.
Sure. And this is going to sound shamelessly sycophantic, but you can see why it's such a delight to work with Liesel. And I think part of that is constitutional for us, because we don't see ourselves as solution providers. We see ourselves as thought partners. We think it is sort of arrogant, candidly, to come to somebody who has wealth and say, we know exactly what you need, not only now, but in perpetuity. We're going to provide those solutions for you right now. Ready to sign the contract? Let's go. And this is, get a little feedback on this? Should I slide this down?
A little bit, yeah.
Better? Good.
Much better, yeah.
So a 30-second backstory. I met Liesel at a conference in San Francisco in a gender lens breakout session. I was 5 minutes late. I missed the introductions. I didn't know who she was. She was introducing herself, and I missed her name, which was actually quite helpful for me, because otherwise I would have been heinously intimidated. And she was relating a story of her journey with her existing advisors and sharing some frustration. She'd been lobbying to the impact for 4 years and had received some sort of modest successes, but was clearly dissatisfied. And I was in a bit of a mood, and I totally came out of my corner, and I said, that's ridiculous. It's your money. It's your money. And I said that you should accept a rejectionist response to what is clearly a passion of yours. And then the conversation moved on, and I didn't think too much about it. And then 6 months later, probably, I got a call from the woman who runs Blue Haven Initiative, which is Liesel and Ian's family office. And she said, we're doing an RFP, and we've heard about you, and we'd like you to participate. And I did not connect the dots. I didn't even know what BHI was. I went and looked online, and there was no sign of it. I was like, all right, whatever, so we'll participate in this. And it wasn't until quite a bit later that the penny dropped. Which is a very, very long way of saying that I think that Liesel's default state of inquiry is perfect for impact investing in particular, but I think it's also perfect for what we perceive to be the inevitable evolution of the delivery of financial services. Because I think this world where an advisor comes in with a solution set without going through what can be a sort of a tedious and very lengthy process of discovery between the two parties involved to come up with the right solutions. I think that it's bordering on malpractice. And yet that is the default mechanism by which Wall Street broadly, I'm sure there's some fabulous exceptions, by which they broadly work. So I think that, it's wonderful to work with people like Liesel, and we're lucky enough to have a few other clients like that in the impact space in particular. Were we prepared to work with Liesel? No. It was a huge leap of faith for Liesel and her husband and her assembled advisors to work with us, and we had long conversations about that. I think that there was an immediate resonance between the way that we responded to the RFP, which was this ridiculous RFP. I mean, we wrote I think it was 180 pages of reply, and it was this core dump of, here's how we think about the world, and these questions all suck, and here's why they suck, this is what the questions should be, and here's how they should be answered, which was totally self-serving, but nonetheless, I think that what they saw in us was a potential thought partner, and they were instantly intrigued with the potential for us to say, we want to work with you, we don't know what the answers are. And so there was a 3-month process whereby they were trying to come to grips with the risk of working with a small, at the time we only had about 1.5 billion in AUM, and as a result, the gravitational pull, the centrifugal force of working with a family like Blue Haven could have pulled our company apart, right? And we were very transparent about that. We were equally transparent about our desire to work with them, but there was risk taking on both sides, and I think that shared risk was the thing that really predisposed us towards a successful conversation. And then in terms of the product, I think, and our ability to execute against impact, we've been doing it for some time, so we had zero hesitation in our ability to deliver that portion of the relationship. Right. It was more sort of the broader context, what does it mean to work with a family office like Blue Haven? Right. We don't know. All right, let's start. Let's learn by doing. And one of the things that Clara said, which I think was great, which is learn by doing. So yeah,
great. Perfect. So let's get into the doing as thoughtful partners and engaged practitioners together, and talk to us about the portfolio construction. Maybe a couple of first introductory remarks. What was the timeline that you applied for yourself in building the portfolio? Because you talked in your opening comments about the journey, the couple of years to even get to the point of rendering the decision, doing the RFP, engaging your advisor. Now you're building your portfolio. So share with us a little bit the timeline that you've applied to that portfolio construction. Describe where you are in that process currently.
Well, and we knew that this would be a process, and one of the phrases that Matthew uses a lot is sort of the cadence of conversion. And so kind of, okay, if you're taking a portfolio and you want to move it to impact or activate it for impact, but then, okay, we could allocate our whole private equity portfolio and all have 2013 vintage year, not wise. So how are we going to kind of space this out? And what we always said is the speed is less important than the quality. And so, we sort of have a I don't even know, a 5 to 10 year kind of, it'll sort of happen as it happens. I don't know. We've kind of moved easier asset classes sooner. One of the things I could actually, let me see if so just for reference, when we're talking about this part of the portfolio that CapRock is managing, so Blue Haven Initiative is our whole family office, and so we think of the assets like this. So we have a donor-advised fund at Impact Assets that we make grants and also make investments from. We have our direct investment portfolio that we manage in-house that has all of our fun startups and all that. I won't focus too much on that strategy today. But then there's this externally managed portfolio, which is what CapRock's managing. So anything that isn't a direct investment or a grant is overseen by CapRock. And so when we're that's the portfolio that we're talking about today.
Although it's important to just at least reference that when go ahead.
Oh, no, sorry, no, go ahead.
And when Blue Haven thinks about their capital, it's all three pools.
Yeah.
Right.
There is a somewhat arbitrary distinction in terms of entity structure, but the way that we think about asset allocation, performance reporting, and impact reporting, it's very much an integrated approach.
But it also has a lot of ramifications. So, our early stage startups that are in Kenya are highly illiquid. That has a lot of ramifications for Matthew's mandate around, liquidity, cash flow, and things like that. So it kind of all plays together. But I would say, in terms of where we're at in the process, well, should I go to?
Why don't you go to the portfolio construction?
Yeah.
There we go. Allocation progression.
Yeah, I mean, this is a fairly simple table just to give you guys a sense of what the allocation has been when we were engaged, which was in the late stages of 2013, and sort of moving from left to right, going to year-end 2014 target, and then 2015 target, and then long-term target. And then right underneath that, there's this table of impact score, which is IPAR, and we'll get into that a little bit later if it's of sufficient interest. And then the percentage of portfolio activated. And that is a pretty important mechanism, measure for us, metric, and we derive it from this concept of intentionality. We think that as Liesel said, and as Clara said before her, there's impact in everything you do, and there's certainly the capacity for incidental impact or unintentional impact in your investments, but we think that incidental impact or accidental impact carries with it a great deal of mission risk relative to that impact, and without that embedded intentionality of the manager itself, then you have an elevated mission risk, i.e. the outcome of your investment could be very different from what you expected going into it. So we pay a lot of attention to that portfolio activated. So, as Liesel said, when they hired us, she'd had modest success working with her previous advisor. About 2% of her portfolio at that time had what we call impact intentionality, so 2% activated. And we were very quickly able to catalyze for impact the preponderance of her public equity and almost all of her public fixed income, hence the 45% activation, but the relatively low impact score, and we'll get into that later. And as of sort of the end of the second quarter, we're at 53%, and we'll be higher than that at year end. But that's also a little bit misleading because that's a forward-looking number. Many of the investments that we've made recently are on a capital call cycle, and so the actual amount of capital that's been called to the strategies is not yet where that would indicate. And we're trying to work through that in terms of how we structure our IPAR as well. So that's later.
Okay, let's dig in a little bit more. Oh yeah, please.
But to Liesel's point earlier, there actually is no fixed conversion cadence.
Right.
Yeah, it's a constant evolution, and what we think of now as impact may be something very different 10 years from now.
Right, right. I thought your quality speed comment was very important as well. You're focusing on the quality, the speed. There's no arbitrary deadline by which this will have been achieved, but it is the intentional pursuit. So let's dig in a little bit on returns, both on the impact and what you've just alluded to, Matthew, and then also teasing out financial return expectations as a framework. On the impact side, the intentionality, and we all know the touch point of intentionality is different, whether it's a private equity transaction or a public equity decision. And so from your point of view, as the asset owner, share with us how you think about that and whether in your mind you're making kind of an impact trade-off, if you will, or how you think about the scale or the spectrum of impact, recognizing the difference of degree in those various undertakings.
Well, I think, one sort of framing device that we use to think about it is sort of what exactly is the money doing and how close are you to the end of the sentence? So from a structural standpoint, can you control who or what is being impacted by the money at the end of the sentence, or how little can you control that? So obviously a direct investment into a startup where you have a board position, you have a lot of control. If you're a teeny tiny shareholder of a large publicly traded stock, you don't. And so the thing is, it's not so much that I see it as a trade-off, but it's you're further away from influencing the impact that dollar can have. And so I think, when we're thinking about portfolio construction and being honest with ourselves about what is the impact of where we're choosing to place our money, you want to take those things into account, which are sort of our impact scoring mechanism is a portfolio construction tool, and it helps us determine that. And so I think that I still, however, I don't need to control what every single dollar is doing. If it's in a publicly traded equity, that's okay with me, but I just I want to know, and I want to be aware of what that dollar is doing. And so that to me is really important. And so first of all, knowing what you own, which is, it shouldn't be as difficult as it is. Like, honestly, for a lot of asset owners, just simply saying to your advisors, I'd like to know everything that I own, isn't something that is immediately available to you. And then saying, well, I'd rather own that or own that, and then getting into that conversation. So to me, I don't see it sort of as a trade-off, but just it's important to know what you can have more influence over and what you can have less influence over. And then how much do you trust the people who do have influence over it?
Right.
So what's the manager intention? What's the manager risk? How are they thinking about how they make selections? And do you like them? Do you trust them? And do you like their worldview? And so, we spend a lot of time talking about how managers view the world, because ultimately, for much of the portfolio, there are gatekeepers.
Right.
And so that's a huge part of it as well.
Great. And Matthew, how does that degree of influence perspective come through in your scoring mechanism?
Yes, we discount effectively one of the factors in our algorithm, because it's 2014 and everybody has to have an algorithm. That's actually only slightly humorous. Is the layers of intermediation. That's one of the factors that plays into the scoring. So we absolutely agree with that. But then there's all sorts of other factors that come into play. And like, for example, I saw Gerhard here with Sirona, and we have Capital Sirona. And Sirona's done an amazingly good job at structuring a fund of funds so that the fee is not actually burdensome to the investor. So we don't like conceptually fund of funds because of the extra layers of fees, but the team at Sirona has done a fabulous job of mitigating that additional cost. And then the strategy they're pursuing, which is private equity investments in frontier and emerging markets, that's not something that many people can do themselves well, first of all, and the cost of doing that can be just totally overwhelming. And so there are times when it's actually appropriate to invest in a structure, or maybe even at a fund cost level, that you wouldn't normally do in order to get the asset class exposure that you're seeking.
Okay. Let's talk about financial return, also in the context of the overall portfolio construction. And we chatted about this a little bit before today, so I'll kick off maybe on this one with Matthew. How do you come at it for your client? How do you think through the total return proposition, financial return proposition, in building the portfolio?
Yeah, we're so iconoclastic. And I know that some of the advisors in the room are just going to be rolling their eyes at me in just a second. But I'm going to use a loaded phrase. What we try to do is liberate our clients from the tyranny of the S&P 500.
That's another battle cry. So we have
right?
Clara's three. We've got Matthew's battle cry. Good.
Okay, so my tongue was in my cheek when I say that, for sure. But how many people do you know who have lives that match the volatility and variability of the stock market? None. Instead, families have liabilities. They pay for school. They have annual expenses they need to meet. And it's relatively easy to do a pretty detailed lifetime discounted cash flow model that allows you to do a present value calculation on all known and anticipated liabilities and expenses. I mean, it's a time-consuming process, but it's not rocket science. Yeah. It's a DCF, right? Yeah. And in order to do a present value calculation and a comparison of your current assets with your known and anticipated liabilities, and it's a futurist game, right? And everybody knows it's just guardrails, it's not a railroad. That lets us say, okay, what does your target after-tax and inflation rate of return need to be? Like, what's the minimum requirement? Okay, can we build a portfolio with the assets that you have that meets that after-tax inflation rate of return without getting you way down the road in risk, or without building some completely wonky portfolio that makes no sense from an asset allocation perspective? And so we start there. And as a result, the notion of performance sacrifice becomes kind of irrelevant, because you have your own personal benchmark. And if you have your own personal benchmark, then what are you benchmarking against? Like, when you're talking about performance sacrifice, what's the benchmark? Now, once you get down from the portfolio level, which is all we really care about in terms of delivering the results to our clients, and you start looking at individual manager performance, or individual companies underneath the portfolios, et cetera, once you start getting down to that level, then yeah, we benchmark everything. It's because we want to know how the managers are doing relative to their peer group and whether or not they're delivering the returns we need on a fully risk-adjusted basis. And we're investors, right? We do that because it's our job. But I just so fundamentally disagree with this whole notion that we need to be judging impact investments relative to a benchmark that is predicated upon the endless extraction of natural resources with no consequence to the external cost. It's like if that's our benchmark, really? Like, what are we doing?
Right. Very well said. And did Matthew share that view at the beginning when you first engaged him, or has that been part of his?
That would have been terrifying.
Yeah. And what was your reaction?
Well, no, I think that though, I mean, I was similar kind of, I don't know, I always felt like I was always taught to look at, you know, okay, well, here's the performance and here's the benchmark. Here's the performance and here's the benchmark. And you're supposed to, this number should be better than that number, you know, and then if that number is negative, then that, you know, like you should just always be looking at this, but then looking more broadly like, well, wait a minute, actually, I'm not sure that that sort of financial economy reflects the real economy that I want to help add value to.
Right.
And so, kind of one thing that I think is also important is do I want to be playing kind of the casino game and winning or losing relative to that, or actually is the way, and for a family office, you know, I want to think about, are we growing real value for our children and their children going forward? And are those investments doing things that they'll look back and be proud of? Okay. And so when you sort of frame it in that context, you know, we want the portfolio to be sustainable and grow in a healthy way, in a non-extractive way. But also, most importantly, we don't want to lose money. Like that's the preservation piece of it is actually, you know, to me, much, much more important. You know, volatility, yes, is important, but it's that drawdown that we don't want to hit. And so, I think that's framing our return expectations in that way has been very helpful for us. But we don't think about it as like, okay, well, over here, this will be concessionary capital, or this will be, you know, oh, it's okay, it's very high impact, but, you know, the returns aren't good enough. We try to look at it a little bit more kind of holistically. Things need to be risk adjusted.
I think this is a really important part of your journey, I have to say, both talking to the two of you and talking to others, people in the room and people who are not here. I think pushing back on some of the default indicators that are put before us and really asking why. Is that even a relevant indicator for my choice, which at the end of the day is really what you're making. You're making a choice on how you want to deploy.
How do you define success? How do you measure the efficacy of your portfolio on a financial and impact perspective? You know, just thinking about one of your sponsors, Microvest. So part of it is that people put impact funds in a box and then start evaluating them from within that box. So what is Microvest? This is not a rhetorical question.
Well, Candace is here from Microvest right in the first row.
Okay, so what is Microvest? Everybody knows Microvest, right? And they do, you know, they provide capital to MFIs in emerging and frontier markets.
Not just MFIs, low-income financial institutions, sustainability.
Thank you. So I didn't know as well as I should. Yeah. Obviously, I need to polish my Microvest pitch.
Yeah.
But when we looked at Microvest, we looked at them as a specialty lender. Okay? So if you think of them as a specialty lender, well, there's, in particular, short duration specialty lender. I mean, throw a rock on Wall Street, you're going to hit 20 of them. I mean, they're all over the place. It's a very conventional asset class, right? Now, they happen to specialize in an area that's very misunderstood. And to us, that creates the misunderstanding of risk. And as investors, we love mispriced risk. We love it. That's where you get your returns from, mispriced risk. Would you rather invest in some incredibly, well, I'm getting way off track here, but their default ratio is de minimis. Now, if they were a conventional lender, they would lever that up 3 times, return 9 to 12% to their clients, and they'd be managing $30 billion. But they don't lever their portfolio. Now, there are some questions around the absorptive capacity of their strategy, so they probably couldn't deploy $30 billion. But I think that, you know, part of this impact investing journey is it is incumbent upon us to reevaluate the way that we think about investment strategies.
Absolutely.
And to not pigeonhole Microvest because they do MFI lending. They're a great specialty lender.
Right. Excellent. Perfect segue to questions from the audience. There are 2 microphones, as I think people saw from the earlier session with Clara. Just invite people to come and introduce yourself very briefly and your question for Liesel, Matthew.
Less interesting than I thought.
Yes.
There's less there than meets the eye.
Well, maybe as people are forming their questions, someone coming out, say, what has surprised you on this journey? Have there been any, either just moments where you thought, oh my God, I was not expecting this?
Honestly, and not just to sort of give an irritating answer, but the wealth of product available, I suppose. I get so confused when I go to these conferences and people are like, oh my God, we would totally put our clients in an impact investing strategy. There's just nothing to invest in. And I get so confused because like we see all kinds of really interesting things. And when I rattle off a bunch of these managers and funds and strategies, all these people that cannot find this product have never heard of them. And I'm like, you know, I don't know, there's a
disconnect
supply demand issue here. But I think actually being able to, and one of the things that we've had a lot of fun with as well, and one of the things I see as a responsibility of our family office, given our size, is being able to work with really awesome managers who have great strategies, but maybe haven't done sort of an impact overlay or a sleeve. So can we find, if we're, you know, a big enough client and we come with other you know, capital that might be interested in such a sleeve, can we make a custom SMA and do something that's sort of interesting as well and make that available for other people too? And so I think that getting creative around, you know, wow, wouldn't it be great if there was some type of debt product that sort of looked and acted like that, but had an impact overlay? I don't know, let's ask the managers. And then you can kind of create it. It doesn't seem as difficult or as kind of daunting as often I see. So I would say actually that's been a surprise. And it might be a function also of you know, maybe our size or maybe just the fact that we bothered to ask the manager if they were interested in doing this. But there's a lot of interest around building this type of product because people are reading all these white papers that people are putting out about all this demand. So I would say that's probably my biggest surprise.
Interesting. Thank you. We have a question here.
Yes, great. Thank you, Liesel and Matthew. I just want to say, number one, thank you for what is, I think, incredibly trailblazing and courageous work. You're essentially taking on modern portfolio theory, one portfolio at a time. One of the questions I have is how, if at all, have you had to alter the incentive fee structure for your advisor, CapRock, to make this work, to really align their interests with yours?
We're volunteering, didn't we say that?
You know, we don't have like an impact performance success fee in our arrangement. It's a, you know, traditional basis point AUM kind of setup. And I think that, and this is a conversation like we've had at our family office around like, and I know there are all sorts of different, I mean, there are lots of managers we employ that do have that kind of success rate. But I think that what we really trusted that what our incentives and our kind of conception of success was also aligned with CapRock's. And we thought that if we do some kind of mechanism like that, we're gonna influence the dialogue, not necessarily in a helpful way. And so, I mean, that could be something we could explore going forward, but for the time being, I think the financial performance and the impact performance, because we don't like to think of them as trade-offs, they're kind of embedded together, and so the incentive structures as well. I mean, that's something I know other people have different views on that, but we thought that would be, we didn't entirely, I suppose, also know what we meant by impact success in such a way as to define it as an incentive structure.
Thank you. Question over here?
Hi, thanks Liesel, Matthew. This is such a great discussion, and thanks so much for sharing your story. I was just wondering, as you talk about success and compensation, I mean, how do you define success when it, in terms of your impact? I mean, across all these different asset classes and geographies and strategies, I mean, how do you think about that?
I think that's a great question, because one of the things that also we didn't do, and this is a function of, I suppose, me and my husband and the things that we're really passionate and interested about, we didn't sort of go to Caprock and say, build us a water portfolio or build us an education portfolio. We're much more opportunistic in that, I suppose, in our definition of impact. I think sort of, as Clara was saying, also taking like, what is it at the enterprise level or at the entity level or at the fund level? Like, what is it that those managers are seeking to do it? Do we think that's a really cool strategy? How do they define impact? And then when we roll up those verticals, what does it look like from a portfolio standpoint? As opposed to us saying, because we could sit, and we've thought about this with our direct investment portfolio as well. You can sit and create this gorgeous thesis and theory of change, and then go and look for opportunities and say, there's nothing there, oh my God, we've got to revise it. And we just didn't want to sit and do that all day long. So we kind of took this more opportunistic approach to impact also. So we define impact as the managers define it in the case of this externally managed account. So what is it that we look more a little bit at the financial instrument. Does it have a cash flow and liquidity and exposure to a certain geography that we're interested in? And is that strategy sort of interesting? And then what are their targets, and are they meeting those targets from our standpoint? And then measure it up that way.
I'm getting a signal here about timing. We have a couple of questions. Do we have time for one more? Or? Yeah. Okay, one more question, and then a wrap up from Matthew and.
Hi, Liesel and Matthew. This is Ann Evans from Ashoka, and it's nice to see you again, Liesel. I wanted to just say that Matthew had offered to illuminate a little bit on the impact scoring mechanism that you're using, and I would particularly love to hear what, if any, of the devices and measurement systems that are out there already have you all found useful. Thanks.
I don't know if we can pop to one of those iPod pages or not. That looks like the next session.
Okay.
You're back. Nope.
So there's a whole industry emerging around impact metrics, measurement, and tracking. And we have a slightly iconoclastic view on that. I mean, we think it's really important, for sure. But we think that in the era of big data, we think there's a seduction around more data equals better decisions. And we don't actually think that's always true. So our system is it's a reductionist system. We think that what we really want to try to do is gather the necessary data, organize it in a way that permits for the universal application of key performance indicators across a whole portfolio, so that when we replace a manager or we activate more capital, we have a very clear sense on what that is going to do to the performance of the portfolio. Okay, great. So here's the output of our impact assessment tool. And what you'll see between the green and the red bar are those 4 boxes. So those are the investable themes at a very high level that we believe we can pursue. And those are sustainability, the environment, and opportunity. Sustainability is simply investments that allow for the more efficient utilization of resources. The environment is investments that mitigate and or adapt to the consequences of climate change. And opportunity is really about investing for people at the base of the pyramid so they can create resilient communities and stuff like that. So, so that's very, very high level. And then at the bottom, we use the Irish taxonomy. Now, anybody who's used the Irish taxonomy knows that it's rich and almost unwieldy. Like if you're an individual company or a fund, then you can select a dozen of the 465 metrics, whatever it is that's in that taxonomy, and that makes sense for you. But at the portfolio level, you're going to end up capturing all of them, and it's utterly useless. You can't use it. There's no steering information in tracking the Irish taxonomy at the portfolio level. So we realize that it's really a data organization challenge rather than a data acquisition challenge. Now I can go on a huge rant on that, which I won't. But, and so when we were trying to translate the IRIS taxonomy into these 3 investable themes, we realized we were missing a layer, and that's what we call the building blocks, which is that table off to the right. And so I think we have 18 now building blocks, and we've mapped all of the IRIS taxonomy to the building blocks, and the building blocks then fit into those 3 investable categories. Now, the 4th one over there is secondary, and that's just for if they get secondary impact, like if you're a public equity manager that's activated, then we'll give you some credit there. That's another rant, which I won't go on. I'm avoiding rants for you guys. You should be happy. So if you can imagine the structure of our system, it's a SQL database, and at the top level, it's the investable themes. At the bottom level, it's the metrics. In the intermediate level, it's the building blocks, and allows you to go from the top down and say, as Liesel and Ian did not do, what I really want to do is focus on opportunity. Let's go out and find all the funds that have exposure to that, both from a building block perspective and from a metrics perspective, and then see how that fits back into the allocation. Or conversely, you can go down to the metrics and say, okay, these are the metrics I think are important. Let's see how those roll up and what funds allow me to gain exposure to that.
I think what's really important about what Matthew's just shared is that you've actually focused on another analytical level that was needed, but you built on something that was already out there in the industry. It's not just discarding and reinventing constantly again and again and again, because I think there's a bit of fatigue with that in the industry, but building on tools that have been disseminated, but as you say, identifying where there are gaps and then solving for those gaps.
And part of that is that we don't think it's our business.
Yeah.
Because this is not our business.
Right.
Other entities are making it their business, and we're very happy to rely on them as data providers, much like in conventional finance we might use Ibidson or Morningstar or any of those services. We like looking at Gears and IRIS as a data provider for the way that we think about monitoring, measuring, and reporting on the impact of our portfolios.
Great.
But there's also, and just to pick up on that, from our standpoint at the family office, like what is the purpose of the measurement? So we went into this whole exercise around sort of measurement theory when we kind of embarked on this. And the thing is so we're not a foundation, we don't have donors, we're not a fund, we don't have LPs, we don't need to provide reports with pictures of children on them, and we don't, you know what I mean? So the thing is I think it's really, really important as an investor to sort of understand when you are measuring outcomes, what's the purpose of that? Is it to report on something so that somebody can say you did well or you did poorly? Or is it a decision-making tool so that you can sort of iterate and learn from and construct a portfolio differently? And so we kind of are trying to also listen and learn from other people in the field that have tied themselves up in knots around this impact metrics thing, and tried to pare it down to what are the things that we think are really important, and also acknowledge that we are at our core opportunistic investors, and we like having the managers and the funds be the ones that are pursuing impact, as opposed to us saying, this is our worldview, go out and do our bidding. And so I think that's really important as well. And so again, this whole process is really iterative, but being honest about how much we can control what those outcomes are doing, and how our measurement tools should reflect that.
So we are out of time, I see. Unfortunately, this conversation could continue on and on. We've been given the signal. So I just want to invite all of you to join me in thanking Liesel and Matthew for sharing what I think is... I'm going to use, in another session, I'm going to use the thoughtful partnership, because I think you really displayed that, a thoughtful partnership in both building and executing on a sustainable impact investing strategy. So thank you very much.
Thank you. Thank you so much.